Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Shares of Morgan Stanley up 6.7% right now. Best day in just about 4 years. Also at a record right now, Morgan Stanley traders and bankers joining the rest of their Wall Street rivals in posting better than expected revenue. It fueled a 32% profit surge for the third quarter, sent shares up the most in close to 4 years. Here's Morgan Stanley CEO Ted Pick earlier today in an interview on Bloomberg TV, speaking to Sonali Basak about his view of the economy and the consumer.
We don't know what the policy reaction function is actually going to be off of what has been said. And for that reason, I think you have a number of investors that are actually just sort of continuing to plow forward on the view that the economy is in pretty good shape, and that consumers and corporates are in great shape. So that when there is an election outcome, once there's a sense for whether new policy will actually get affected, then they can have a reaction.
I couldn't help but notice he said when there is an election outcome. A lot of folks saying it won't necessarily happen the day after 3 weeks from yesterday. We got with us Alison Williams, Bloomberg Intelligence Senior Global Banks Analyst. She joins us here in the Bloomberg Businessweek studio. Alison, quite a few highlights from this report. Revenue from the trading business rising 13%. The wealth unit also standing out higher than analysts' expectations. What worked so well for Morgan Stanley this quarter?
I think it was the rebound in wealth flows that investors are excited about. But to be clear, the business is hitting on all cylinders. So there was a broad beat across the bank. The institutional was the biggest source of the beat this quarter. Equity trading, very strong. They're tilted more towards the business. It was strong for everybody, but they also had a little bit better growth there. Debt fees also sort of leading the way on the fee side of things. But the wealth business really is the core of their business. They've shifted more towards wealth and asset management over the years, especially under Gorman. And they had sort of a little bit of a shortfall in flows last quarter. And so I think really seeing the strength of the rebound is giving investors some confidence in those shares.
Let's talk about the shares, though, because Morgan Stanley shares up about 6.7% at the moment. At one point, they were up by more than 8%. Currently, the biggest rally since December 2023. When it was up by 8%, that was the biggest rally since November 2020, which was quite a time in markets, to say the least.
Yeah, that vaccine, right?
Yes,
coming
exactly.
out
That was
for COVID.
That was wild. I think it was on Monday too. What a way
I remember that day.
Yeah, me too. You were here. You had been here for like a month.
Yeah.
Yeah. Anyway, Alison, like you said,
and hitting new highs.
Yeah,
so
record
I think,
highs.
in general, this earnings season, the stock reactions have been very strong.
Right.
I think investors are getting excited about the capital market story. I think trading, we had so many years where it was underwhelming.
Right.
The pandemic, huge surge. And since then, we've really seen trading prove to be resilient.
Yeah.
This year, it's equities that's outperforming, but we're within a historically high range. And then on the investment banking fee side, that super strong year, 2021, all kinds of records. It's weak since, but now starting to see some signs of life. And so I think investors
Alison,
are getting excited about both of those things.
I hear what you're saying, but is it that good? I hear what you're saying, that they beat across the board, firing on all cylinders. Is it worth a 6.7% reaction in the shares?
So again, so we don't comment. We don't recommend stocks. I just have to be careful about
No matter how
comments.
much we ask, you will not.
I'm not asking for a recommendation.
If I was an investor, I guess the way I would think about it is it's a super strong market. I think about both Morgan Stanley and Goldman as riding a strong tailwind. So they have strengths. They're leveraging those strengths, but there is a very strong tailwind from the market. And the view going forward is, do you think that momentum continues? We see momentum in the near term, but I think you have to think about sort of the weeks and months ahead. Morgan Stanley, again, has some pretty aggressive targets out there for AUM growth set out by Gorman. The wealth management pre-tax margin, when markets are up, revenue is up, margins are good. But they, Ted Pick had lowered that a little bit in the near term. Will he raise that back up towards the higher 30% goal? And will Morgan Stanley march towards that over time. I think that's the long-term question for Morgan Stanley.
Can you help me and our listeners and viewers understand the asset management business, the wealth management business? Because we hear over and over again, in the long term, it's difficult to beat just investing in indices. I know it's, kind of sacrilegious to actually say that, but if you look at the research,
you're towing a dangerous path here.
You see that time and time again, Alison, yet you still have these banks attracting very smart money for a product that charges a fee. What do clients get, and what are investors getting out of that?
So I'll say a few things. So Morgan Stanley's investment management business, I know pretty well since I used to work there. The strength there is alternatives and fixed income, where you definitely do see good returns. Their equities business is actually very focused on active, having a very strong active share and concentrated bets, so it can be more volatile. So I think within, the argument about, when you look across and all managers aren't going to beat the index, right? But I think if you are buying an active fund, you do want to buy something that is making bets, right? Not just hugging the benchmark, as you say. And so I think that's what we've seen in the industry over the last, a decade or so, perhaps longer, but accelerating is, look, I can get beta cheap. I can get those cheap funds, those index funds. But for alpha, right, you are seeing flows, and you see it also on the hedge fund side as well. The hedge funds that can deliver consistently better returns are the ones that are getting assets. And turning to the wealth side of things, I would also say that business has really evolved over time. And so, years ago, maybe at the turn of the century, if you will, it was about fund of the month, or this stock will make you the most money, this fund will make you the most money. But the industry, I think, is really focusing on client needs, client investments. And so that's really been a shift.
30 seconds now that the big banks are wrapped up. We heard Ted Pick say that consumers and corporates are in great shape. How would you characterize, Alison, sort of the holistic view that we got from the big banks over the last week or so in terms of commentary on the consumer? Good place?
I think it's very good. And I think that's another reason why you're seeing some strong reactions, because things, healthy, credit came in healthy, right? That's what people are concerned about. And if rates are coming down and we are tilting more towards a soft landing scenario, that's very good for the banks.
Alison Williams, Bloomberg Intelligence Senior Global Banks Analyst, joining us here in the Bloomberg Businessweek studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Okay, Katie Greifeld, think back to recent history of presidential campaigns.
Okay, I'm doing
Barack
it.
Obama, 2008.
I remember him.
You think you were in high school at this point?
I was.
He was pitching back then a complete overhaul of the U.S. health insurance system. Now we have Obamacare. 4 years later, Mitt Romney, he had the elaborate set of proposals for reigniting economic growth after the Great Recession. Hillary Clinton in 2016, she had the position papers on everything from raising the federal minimum wage to establishing paid family leave. This all from a recent column by Bloomberg Businessweek editor Brad Stone, who writes that this presidential cycle has been largely devoid of such ideological ambition. He argues that it seems like we've lost our appetite for big ideas. In many respects, it's been the Ozempic election. Brad, not just the editor of Bloomberg Businessweek, he's also the author of 4 books, including New York Times bestseller, Amazon Unbound, Jeff Bezos, and the Invention of a Global Empire. He joins us here in the Bloomberg Businessweek studio. Brad, what are we getting from the presidential campaigns this time around if we're not getting the big ideas?
Yeah, thanks, Tim. Look, I don't want to minimize it. I mean, Kamala Harris, the campaign's gotten off to a late start. We've gotten targeted proposals aimed at helping parents, renters, first-time home buyers. I don't want to minimize former President Donald Trump's proposals. Those tariffs would be a significant change to our economy. But when you look back at the kinds of sweeping economic proposals that Barack Obama was making, or Bill Clinton or the first George Bush, really big ideas, and you wonder why it's not happening this cycle. And I think there are two reasons. The first is tactical. I mean, it may not be as much of an ideological battle, but it is certainly a battle between parties, personalities, kinds of sides of the American divide, and both sides see the other's success as an existential threat and are determined to win. And winning right now involves cobbling together a coalition. It's why Trump is talking to all women today on Fox News, and the vice president's doing a town hall with Fox News. This is all about 7 states and swing voters. And then the second question is really, what can you get? Can you get anything sweeping done today in a bitterly divided Congress that is devoted to the politics of opposition?
Right. Recent history would suggest no to that last question. And you hedged yourself nicely. You said you don't want to minimize this. And my pushback would be something that you touch on in the piece. You have Donald Trump proposing 19th century style tariffs. Is that not a big idea?
No, I think in its way, it is a big idea. So it's certainly dramatic. I mean, there are real open questions about how kind of serious he is about it and how much he can get done. But in terms of like identifying the gaps in the American safety net, the institutional challenges we have, the existential threats to the country, to the world, like climate change, like solving the ballooning deficit, neither candidate has really addressed the kind of, sweeping problems that we have, in part because those problems often involve a big dose of reality and a heavy dose of bad news. And they're both trying to, as I said, cobble together a winning coalition and prevent the other side from taking power.
I wonder if this changes after the election, and if somehow whoever wins the election is given a dose of reality by maybe some sort of crisis or bond vigilantes.
Well, it's more than that.
Pushing back on their ideas.
I mean, I'm old enough to remember where winning presidents had a honeymoon period where you could talk about the first 100 days, where even if you didn't have both branches of Congress, you came out of an electoral victory smelling like a winner, and the other party kind of fell into line and let you pass an element of your agenda. I don't think that's going to happen. I think the dose of reality is coming from, we go back to what Mitch McConnell said in 2008 when Barack Obama won, and he said, our mission is to make him a one-term president. And those are the politics that we have right now. And until we move beyond the politics of opposition, I think and this is the point of the piece, that our presidential candidates, our national leaders, are going to have to be a little limited in their ambition so that they don't end up over-promising and under-delivering.
Well, you also write that it's a vicious circle. And I was going to ask, do you think that it's realistic that we do get to that place where we do move beyond this cycle, or whatever you want to call it? Or do you think that it's actually built into the way that we elect presidents for this dynamic to unfold?
This is where, Katie, I'm trying not to come off as like the cynical old guy. I mean, I think we need to maybe flush some of the current politics out of our system. Maybe that's through decisive defeat of one side or the other. I think the parties have to come to a kind of reckoning about putting country before party. And I think it's going to require a superlative leader who can get beyond the politics of opposition and the feeling that the other side's success is an existential danger. And whether either one of those two candidates are that superlative leader who can grow beyond, our current situation, our current paralysis, I think it remains to be seen.
Help me be not cynical about this, because I'm thinking to myself, okay, I don't see this improving in a world where California has 2 senators and Wyoming has 2 senators. So essentially, the representation that somebody in Wyoming has in the Senate is essentially much greater than somebody in your state of California, given the population differences, but the structure of the government and the fact that it only matters in 7 states when it comes to the presidential election. It's pretty tough out there.
It is. And I think also a major problem is that some of our institutions that used to unify this country. Local media, local parties, where parties, by county, by state, would differ from the national party. Those intermediating institutions are also on the decline, and trust in them has never been as low. So, I agree with you. It's hard it's hard to find reasons for optimism. With the current state of affairs, the kind of institutional change that I am talking about a little bit in the piece, getting rid of the filibuster, getting rid of the electoral college. Frankly, it's very difficult to see how we achieve those. Those are such.
I could see one group wanting to get rid of the electoral college, and one group not.
They seem a little third rail right now in our current politics.
Well, talk to us. I mean, we were talking about Congress earlier and how it's hard to get anything done. We did get certain things done. You think about the Inflation Reduction Act, for example. I mean, I speak to a lot of executives, and a lot of them have cited to me that has been a big help for them. And then, we could get into the CHIPS Act, but with what's going on with Intel, that's a different conversation. But in any case, talk to us about how that can still happen, even with this gridlock that we have.
Exactly, and the president has used the budget reconciliation process, and there are some strict rules on what you can get done through that process, and then with a simple majority. And recently the vice president has cast the deciding vote, but they do have to be budget-related items. And so, when you talk about things like raising the minimum wage, it's almost ridiculous that in decades it hasn't been accomplished. Or, universal child care or parental leave, the things where this country now badly lags most of the developing world. You can't get it done because it would require a filibuster-proof majority in the Senate. So there is this tiny little loophole to kind of get things done, and the Biden administration. And executive orders are another way, and obviously when Donald Trump was in office, he took full advantage of that, as has President Biden. But those are like the mechanisms that are left at the disposal of the current and soon the new president, and those are weak institutional levers.
One thing I wanted to get your thoughts on is the way that the candidates are leaning into media in these last 2.5, close to 3 weeks. Yesterday, Donald Trump sat down with John Micklethwait, editor-in-chief at Bloomberg News at the Economic Club of Chicago. Here's what he had to say about the Federal Reserve.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all.
There you have Donald Trump yesterday with John Micklethwait, the editor-in-chief of Bloomberg News, out there at the Economic Club of Chicago. Brad, I want to get your thoughts on this because we heard a lot from Donald Trump yesterday. You sat down with him over the summer for a Bloomberg Businessweek cover story. Who was the Donald Trump that you saw yesterday in that interview?
Well, first of all, it sounds like Donald Trump wants to be the Fed chief.
Everybody
treats him so well. Look, we spoke to Donald Trump 3 long months ago, before 2 assassination attempts, when he was still running against President Biden. He was feeling pretty good. He was more disciplined than he usually is back then. He was, in a lot of ways, introducing his economic plan. Some parts of that plan remain unchanged. He does differ on the details, the extent of his corporate tax cut, the extent of tariffs on China and the rest of the world. A lot of the elements remain the same. What's different now is, in his own unique way, he's trying to expand his coalition. He's there in Chicago. He was in Detroit speaking to the Economic Club there. Trying to expand his support in the Midwest, which he sees as crucial to his victory. But, certain things he can't change, right? He actually was very civil to us back in July. Mm-hmm. He really did, in a very strange way, lash out at his interviewer, our boss, yesterday. Yeah. I think, again, like destabilizing or diminishing those intermediating institutions, diminishing people's trust in them as a way to raise himself up.
Brad, we're going to have to leave it there. Brad Stone, the editor of Bloomberg Businessweek. If you never want to miss a Bloomberg Businessweek story. Become a subscriber today. You'll unlock deep reporting and analysis from reporters around the world, including unlimited access to Businessweek. Check out our offers right now on Bloomberg.com/subscribe now.
You're listening to Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
It is Bloomberg Businessweek. That's Katie Greifeld in for Carol Massar on this Wednesday afternoon. I asked her before we went to break if she'd started her holiday shopping season. She said the answer is no. Katie, it's not too early.
You know what you do, Tim,
What?
is actually you buy a gift on Amazon like the
Okay.
day before you see your family. Then you print out what you bought them on Amazon, and then you give them the piece of paper. It's sort of like an IOU.
It's the thought that counts, and that's a
Yeah.
nice thought.
Yeah,
they say.
absolutely.
Hey, the management consulting firm PwC, a couple weeks ago, they crunched the numbers. They found that even though holiday spending is projected to surge to a record high, the increase this year is less than the increase over the previous 2 years. So, yes, it's still growing, but not growing as much as it did in recent years, according to forecasts from PwC. Let's see what Tom McGee has to say about all this. He's president and CEO of ICSC. It's formerly known as the International Council of Shopping Centers. It's the trade association. They represent retail real estate. So think shopping centers, malls, and the like. Tom joins us once again from New York. Tom, good to have you with us. You are in a really interesting position because you represent the folks who have the real estate when it comes to these bricks and mortar retailers. What are you finding in the sense of how are they thinking about the upcoming holiday shopping season?
Well, first of all, good afternoon. It's good to be with you again. I think we're looking at a solid holiday season. You know, our expectation is 3 to 3.5% growth. I caught your observation around PwC's prediction. You know, ours last year we predicted 3.5 to 4%. It ended up slightly below 4%. So we're a little less than last year, but still very solid. The consumer continues to be resilient. Certainly concerned around inflation. But 70% feel their financial situation is better this year than last year at this
That's
time.
interesting.
So, you know, 241 million people expect to shop this year, 6 million more than last year. But clearly, still concerns around inflation, still concerns around the economy, but the employment market is strong, and the consumer continues to be resilient. And so we expect this to be a solid holiday season.
And let's talk about how people are spending their money and how they're shopping. You have some really interesting stats. And turns out I think I'm in the minority here because you found that 92% of shoppers will actually spend time in a physical store. Just 8% will buy only online. Tom, I had to admit, I found that surprising.
I think most, you know, the name of the game in retail today is omni-channel. I mean, we've coined this year the year of the store. And the reason we called it the year of the store is not because people are only shopping in stores. We recognize people are shopping online and increasingly shopping online. But the store has become kind of the central point, the focal point for the consumer experience. So even though people will shop online, a lot of those orders will be fulfilled out of store. The store has become kind of a mini fulfillment center, in addition to being a product of the traditional shopping experience. So really, it's about both. People will shop in both channels. There are clearly some folks that only shop online, but I bet you, Katie, you'll find yourself in a store at least one time over the course of this holiday season. So that gets you the 92%.
That's the perfect segue because I know this is not all about Katie, but I do want to ask specifically about her. How do you get Katie Greifeld not to spend those dollars online at a place like Amazon and instead think about this ahead of time and push her into a retail store to get this shopping done? I mean, in a sense, it is better for last minute shoppers like herself, right?
Certainly a store, obviously for last minute fulfillment, is going to be the most effective. And retailers really do want people like Katie and all consumers to shop in both channels. Quite frankly, I mean, most retailers are somewhat agnostic in regards to where you initiate that transaction. They would prefer for that transaction to be fulfilled out of a store, and fulfillment can be accomplished in multiple ways. They can ship it out of the store, and increasingly many retailers are fulfilling orders out of the store, shipping from the store. And that's why those retailers that have a lot of scale and have a large store footprint do tend to do well online. But they also like consumers to come and pick it up in the store on curbside pickup, click and collect, et cetera, because that saves the shipping costs, and it also gives them another opportunity to engage with you. The name of the game in retail really is to be effective in both channels. There are some retailers, Amazon being one that isn't strictly online, but is predominantly online. There are some retailers that are not strictly physical, but are predominantly physical. But most retailers are trying to be effective in both channels. And that's really, really important because people have just come to expect that. They've come to expect a consistent experience. And you know, one of the untold stories in physical retail right now across all sectors, but particularly in open air retail, is that there's really a lack of supply to meet the demand. Many retailers, including many large national retailers, including the Walmarts of the world, have announced that they want to open up more stores, and there's not enough supply to meet that demand right now. So the competition for suburban open air retail in particular is exceptionally strong, and the competition for that supply is very fierce right now.
Tom, gonna have to leave it there. Always love it when you join us. Thanks so much for swinging by Bloomberg Businessweek. Join us once again before the end of the holiday shopping season. That's Tom McGee, President and CEO of ICSC. They represent the real estate when it comes to those retail folks.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Katie.
Yeah.
Look at the clock.
I know. We are rapidly approaching the market close on this Wednesday. I just figured out it's Wednesday.
What's it like? You open the markets on open interest. You close the markets on Bloomberg Businessweek.
I certainly do. It's exhausting. As we were saying with Abigail, I mean, this market has been so weird. I'm standing there, you know, at 9:30, nothing is happening. And then by the end of the day, I mean, whatever the move was at the open, it's not the move at the close.
Let's see what Nancy Tengler has to say about this. She's CEO and Chief Investment Officer over at Laffer Tengler Investments. She's also the author of The Women's Guide to Successful Investing. When it's not cold in New York, she comes and visits us.
With great shoes. She has great shoes.
But, you know, days like today where you like wake up and you're like, okay, this is fall. We're kind of getting to winter. Nancy finds herself in Arizona. How are things in Arizona, Nancy?
I'm melting.
The air conditioning is still on there?
So hot. It's still hot. Yeah.
Wow. Okay.
Does it ever come off? I've never really been to Arizona. Help me out.
Yeah, it does. It's the winter's pretty awesome. But actually, as a native San Franciscan, guys, I love coming to New York when it's cold and bundle up and walk around. So I'll see you soon.
Okay, good. Come visit us soon.
Yeah.
What do you make of these markets? Are they weird like Katie described them?
Yes. And it is exhausting. The last couple of days have just been befuddling. But I think what we're going into is the crazy season. And, you know, we're waiting for the October surprise. The election is getting closer and we're in earnings season. But so far, so good on earnings. I mean, through yesterday, almost 3/4 of the companies beat on earnings and almost 60% have beaten on revenues. So 5th consecutive quarter of 5% revenue growth. That's impressive in a declining inflationary environment. So I'm really encouraged about earnings going into the end of the year.
Well, let's talk about the end of the year, because even if you have, of course, that piece with earnings, the corporate fundamentals are good. I mean, is that going to overwhelm potentially worse news on the macroeconomic side coming from the Fed? Because there's a lot of question marks over whether or not that rate cutting cycle that markets had priced in is actually going to be as robust as expected.
Once again, the bond market got ahead of itself.
Yeah, unsurprisingly.
I think a couple things, Katie. I mean, if you go back and look, there have been 9 easing cycles since 1974. 4 of those were without a recession. And the median return 12 months out was 18%. So I don't know if we get another cut in November. I'm guessing this Fed seems to want to cut. So I'm guessing we will, and it'll be 25 basis points. But I don't think it's necessary because we really have a strong economy. I mean, GDP now for Q3 is coming in at 3.2%, according to the Atlanta Fed. And, you know, we're seeing a decent job market, not layoff, you know, hiring has certainly slowed down, but layoffs have not necessarily picked up. Wages have grown dramatically for union workers. So I think well enough, just leave well enough alone and let the companies do the work. Let them deliver the earnings and margin expansion.
Well, when it comes to leaving well enough alone, it's something we were also talking about with Abigail Doolittle a little bit earlier. The fact that we've had such a strong start to the year, at least yesterday when I checked this stat, yesterday before the market opened, that this is the best start to a year for the S&P 500 since 1997. I mean, it has been a fantastic year so far, Nancy. And with all the different, cross currents that we're talking about, I mean, how tempting is it to just sort of say, okay, I'm just going to ride out through the rest of the year. I don't need to make any big, bold bets right now.
I think that is the right strategy. We were broadening out about a year ago, and I've talked about on your air a lot about how we have really been talking about this for 2 years, that this market and this economy is analogous to the 1990s because productivity improvements are driving margins and are driving earnings growth. And so when you have that, you really should just let the companies continue to invest, deliver productivity. Unit labor costs are down to like 0.3% last quarter. That's pretty impressive. And yet productivity was almost 3%. So I think we are in the early stages of this AI-fueled, productivity-driven growth, and we ought to just let the companies do their work and own the best ones and not try to figure out which sector is going to outperform in a Harris administration over a Trump administration. Because I wrote in my notes, when Trump got elected, the conventional wisdom was that technology would suffer and financials and energy would outperform. And in fact, the exact opposite was true.
Nancy, speaking of the election, if we were talking 3 weeks from now, the Wednesday after Election Day, what's the conversation we're going to be having?
Yeah. I don't know. Well, half of us are going to.
Well, she's got a crystal ball. I'm just asking her to look into it and share what she sees.
Let me consult it. I think we're going to be talking about tax policy. The TCJA. I think that is really the critical issue, no matter who is elected. Will it be allowed to sunset? The 100% expensing has been declining, expected to get down to 20% in 2026, I think. But there's the foreign tax, and then there's just the corporate tax rate. And what's interesting, Tim, is that if you look at corporate tax receipts since the TCJA, with all the repatriation of earnings, they've doubled from 200 billion to 400 billion. So kind of interesting. I was on the Fed's website, in my spare time, and that instead of the gambling sites, Katie, and that really caught my attention.
That is really interesting. I am curious. I mean, Tim and I were talking about it a little bit earlier. Part of the reason I love talking to you is because you're really into high conviction sort of trades, these relatively concentrated portfolio. I mean, where would you say at, October 16th, after this fantastic year-to-date run that we've had so far, what's your highest conviction right now, would you say, Nancy?
I think industrials. So we added Uber to a number of months ago to our 12 best ideas portfolio. They were the big winner at the Tesla event, which I attended. We Robot. That was the stock that rallied after that event.
Big time.
But we also like names like Power, PWR, which is Quanta Services, Schneider Electric. These are the companies that are building the infrastructure for the data centers. I bought an electric utility for the first time in 35 years under the power demand. And we're looking, like everyone else is, for interesting ways to play the increasing demand. But those names I mentioned, plus Carrier, which is cooling the data centers, those are the kind of names we want to own. We also added T-Tech and we own Xylem. So these are companies that do water treatment. And I think all of this is going to become critical. We started our conversation talking about air conditioning in Arizona. We're ending our conversation talking about cooling data centers and Carrier. Circle. We're coming full circle. Nancy Tengler, thanks so much for joining us. She's CEO and Chief Investment Officer at Laffer Tengler Investments, joining us from Scottsdale, Arizona. Nancy, also the author of The Women's Guide to Successful Investing.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.